Hey guys, welcome back to the show. Today we're going to talk about fund of funds, and today I got Lincoln Archibald with me.
Hey guys.
To walk us through. We're both going to be talking about what is a fund of funds, how do they work, how could someone like me or you set one up, what benefits do they have to investors. We're going to go through the whole 9 yards. So Lincoln, talk to us first, high level. What is fund of funds? What are we talking about here?
Yep. So you guys have seen this before, right? Your general partnership and your limited partnership.
And if you haven't seen this, go check out our other videos.
Yeah,
so this is the basic fund structure of how a lot of funds are structured.
And so normally your fund would go and invest in, your assets, right? And you'll build a portfolio of real estate or venture capital or private equity. But in a fund of funds model, instead of investing into just different investments, you're investing into other funds, okay?
In the name, right? There you go. It's pretty self-explanatory.
But there's a couple of things that you should know, right, about fund of funds, how they work, and some differences than just running a regular fund. Okay, so in this example, we've got 4 different funds that this fund of funds is going to invest in, right? If you haven't seen some of our other videos, you normally charge a 2 and 20 in a regular fund setup, right?
So that'd be a 2% management fee, 20% carried interest. And yeah, go check out other videos if you don't know what that means.
You may be asking, like, well, what does this investor do? Like, do I charge another 2 and 20 up front, which makes it a 4 and 40? How do I charge fees that, justify this investment?
Well, and then the other question is, why doesn't the investor just go to these funds themselves? Why would they use you in a fund of funds model?
So let's talk about that. So let's say that this fund is a VC fund, right? Let's say their expected return is 41%. For the forward year. We'll come back to this in a sec. But the minimum contribution to get into this fund is going to be $2 million. And let's say this investor only has $2 million, right, that they want to invest. Do they want to just go throw $2 million into venture capital? Maybe this is like very high-risk tech companies, right? Alternatively, a benefit to a fund of funds model, so this is a private equity fund, a real estate, and let's do another real estate fund, is that this investor can get exposure to all of these funds with their $2 million by investing into the fund of funds model.
So additionally, like Lincoln said, $2 million minimum commitment. A lot of these funds, these high level funds, Ray Dalio, a great example, minimum commitment to Ray Dalio's funds, $100 million, right? And he usually just turns it away. They don't even need money. So a regular investor, even a high net worth individual with $2, $5, $10 million cannot get into those funds. So first benefit right here, investors can get in. That's our very high level, terminology. They can just get in, but they can get into some of these very exclusive funds.
So let's come back to these performance fees, right? How does the fund of fund make money? Let's say for this example, these are expected returns of the fund. Let's say this private equity fund's expected return is 33. This is 21. This real estate fund's 11. The way you figure out what to charge in a fund of funds is, so I actually called, I have a friend at Goldman Sachs who manages a fund of funds. And he says that, the best way to do it is you just got to reverse engineer your deals, right? You've got to look at, what type of funds you're investing in, how good, if you were investing in funds that you think will all return 41%, you could totally constitute a 2 and 20 and a 2 and 20, right? Because then your investors are going to get paid, you're going to get paid, these funds are going to get paid, right? However, you probably don't want to go into all these funds that are saying they're going to get, 50+%, maybe a little sketchy. So, you just got to reverse engineer the numbers, and maybe you need to knock this down. Maybe this should be like a 1% management fee and a 5% carry, right?
And the reason you're looking at it is because obviously your investors are now getting charged 2 fees, right?
Yep.
Getting charged here and here. And just a note as well, you have to disclose that to your investors. The one rule, we'll say it over and over again, disclosure, disclosure, disclosure. Make sure your investors know that they are getting charged by 2 fees essentially here and here.
Usually the fund's performance will be, disclosed on a net basis, right, of fees.
So a second benefit that we didn't really mention here was the diversification of investment. Lincoln alluded to this earlier. We want to put it on the big board right here. Is they are now, instead of just $2 million in one investment, they can do $2 million in 4 or 5 different investments.
Yep, that's right.
Now, so number 3 benefit, first, investors can get into these exclusive investments. Number 2, you get diversified between a lot of different funds. And number 3, huge benefit of fund of funds is that you as the fund of funds fund manager now has negotiating power over some of these funds. There's a lot of funds out there. For instance, one fund that I know very well, if you put in, I think it's over $10 million into their fund, they, instead of charging you a 2% management fee, will only charge you a 1.5% management fee. And if you put in over 30 million, oh, hey, we'll drop your management fee to 1%. So what happens, and you can even write this down, you get discounts on these funds. So when you invest, because you have such a big portfolio, usually fund of funds are large. 100 million would be a small fund of funds. You're usually well over $100 million. So you have big negotiating power with each one of these funds you're looking to invest in.
That's right. Like if this fund, let's say this fund's raising $50 million, if you gave them a $25 million investment, that's half the capital they need. For fund managers, usually the hardest dollars to raise are the first dollars, right? The first people to invest in the fund, and after that there's momentum, right? It's like, oh, we've already raised 25 million, we've only got 25 million left, like you better hurry. And it shows other investors that, hey, this is a good investment. It's the same thing with early stage companies, right? Like when they're taking on VC dollars, right? If one VC invests and they're only raising, a certain amount in a round, then the other venture capitalists sometimes won't even vet the deal. They'll just throw money at it, right?
It's like the same as Black Friday. If you're running to Walmart and there's 10 TVs and people are grabbing them, you're just going to grab a TV too, right?
That's right. That's right.
It's going,
So that's another benefit. So let's say this fund, they know you, they can count on a $25 million investment every time they start a new fund, right? You're definitely going to have some benefits there, right? These relationships are important for a fund of funds manager.
Okay, and I'll put down number 4, benefit, and this is kind of to you, so maybe you can put a little line or something. Benefit to you as a fund manager is once you have gone through the work for you is you got to go vet these funds. You got to go meet fund managers. You're vetting all these funds you're looking to invest into. Once you've invested though, these are fairly passive funds, right? You are invested for, a lot of these funds are 7 to 10 year funds. You invest and you just count your check. Every quarter, you've got to have your accountants make sure everyone gets paid correctly. You file your taxes. Great, right? It's a very low maintenance fund once it's set up, once the capital is deployed in a fund of funds model. So maybe another bonus just for you and not to your investors as much, but it's very hands off. So to review, number 1, investors can get into funds that are very exclusive, sometimes have high minimum commitments. Number 2, the investor gets diversification among a lot of different funds.
Yeah, like look back to the COVID crisis, right? If one of these funds were commercial real estate in large cities, right, your portfolio would have gotten hammered. But investing into a fund of funds gives you that diversification across different asset classes. And then third, of course, is your discounts, right? This negotiating power between the LPs. And look, sometimes these funds, they're not easy to get in contact with, right? They're pretty exclusive. But if that fund manager, if you have that relationship, then you've got the in through the fund of funds. Now, and number 4, it's just, it's more of a passive management play. It just doesn't require as much active, daily investment analysis or whatever.
And with that hands off, which is nice for fund managers, the other thing you need though more of, so it's less hands off, but you need more capital.
Yeah.
So if you think back to, we've had other videos talk about the 3 circles of a fund. You have your expert investor, your fund manager, and your money raiser, kind of the 3 distinct pieces of a fund. If you're weak on the expert investor side of things, but you are very strong on the money raising part, a fund of funds might be a good option for you. Yes, you still need to understand how funds work and how, make sure these are good vetted funds. You have audits, you're looking at them, but I think it's a little bit easier than trying to build an algorithm that's going to go trade the S&P 500 versus the euro dollar versus whatever, right?
Yeah.
It's a little bit, I would think, at least for me personally, a little bit easier to do that and a little more hands-off.
And maybe one last thing too, people think sometimes fund of funds have to invest in well-established funds, right? I've seen funds of funds that actually invest in new funds and take an equity position in their general partnership, right? If you're giving a new fund manager some equity, maybe it's $1 million, right, to cover their first couple years of expenses, and then they take, a portion of the carry to that general partnership, right? So
it's almost like a venture capital fund of funds, essentially. You're investing in these small almost seed funds. Yeah. So that's it for fund of funds. If you have any questions, drop them below in the comments wherever you're at seeing this video. But this is a pretty cool model that a lot of people don't know about and actually can be very lucrative for fund managers and for investors.